In this video, we are going to understand that what will be the impact of the monetary policies on the money supply. Now we know that the central bank takes various policies to regulate the money supply of an economy to stabilize the economic system. So, in this case, we have considered five situations and we will try to understand that using these monetary tools, how the central bank, in case of India, the central bank is RBI or Reserve Bank of India. So, how the Reserve Bank of India will control the money supply. So, first incidence here is written as the increase in bank rate. So let me highlight it. In this case, first we need to understand that what is bank rate. Bank rate is nothing but the rate at which commercial banks take loan from the central bank or from the RBI. So here basically RBI is giving loan. So from RBI, the loan is going to whom? That is the commercial banks. Commercial banks. Now, if the RBI increases the bank rate, that means the loan that the commercial banks are taking from the RBI that has been increased. Or, in other words, we can say that the loans now became expensive. So, since the loan is now expensive, definitely commercial banks will not be willing to take more amount of loan from RBI. So, in that case, the amount of money that is available with the commercial bank to give to the public or to use for public borrowing will also decrease will also decrease. So indirectly basically it will affect the money supply. So the amount of money available with the commercial banks that the commercial banks can give loan to the public will decrease, which is nothing but the money supply. So here the money supply will decrease if there is an increase in the bank rate. Hope it is clear to all. Now the next question is what will happen if there is an increase in the repo rate. So now we are going to discuss the second phenomena. Remember one thing, that this is also the rate at which RBI or central bank gives loan to the commercial banks. So, to the commercial banks. But there is a small difference between these two. What is the difference? The difference is that in case of repo rate, collateral collateral exist. That means the commercial banks have to keep the collaterals with the RBI at the time of taking the loan. And here also the mechanism or the impact of this increase in repo rate will be same on the money supply. That we can see the money supply will decrease since the amount of money that will be available with the commercial banks to give the public for borrowing or for public borrowing, that will go down. So for the second case also we have seen that the money supply will decrease. Now we will discuss the third point. The third point is increase in lending margin. This lending margin, what is the lending margin? First we need to understand. This is nothing but the margin requirement. So margin requirement is basically a requirement. Just let me write it. Requirement is nothing but a qualitative measurement or qualitative tool that the central bank uses to control the money supply. What is this margin requirement? Margin requirement is basically the difference between the current value of the collateral and the amount of money that the commercial banks can give as a loan to the borrower. Let us take an example. Say you have a house and the value of the house is rupees 1 crore, and this is the current value of the house, and in this case suppose this margin requirement is 40%. That means the bank can give only the 100 minus 40, or we can call it as the 60% amount or value of your collateral, that is 1 crore, as the form of loan to you. So what will be the amount? The amount will be rupees 60 lakh. So bank can offer you maximum 60 lakhs of rupee loan if the margin requirement settled by RBI is 40%. So in this case, if there is an increase in the margin requirement, that means, for example, commercial banks can give loan uh, is only 50%, or say for example, the RBI has increased the required margin from 40 to 50%. Now for the value same value of your collateral, that was 1 crore. Now the available amount for the loan offering is only 100 minus 50, or 50% of the collateral. 50% means only rupees 50 lakh now bank can offer to you in the form of loan. So, in conclusion, we can say that if margin requirement increases, then the money supply will go down. So, this is the impact of the increase in the margin requirement. Now, fourth component or fourth scenario is what? Let me highlight it. Buying government bond. Now, in this case, buying government bond means what? Government is buying bonds from whom? From public. Government is buying the bond means government is the buyer. So, government is the buyer. And who is the seller from whom the government is buying the bond? From the public. So, public is the seller. Seller. Now, who is buying? Government is buying. To buy, government is paying the money to the public, and public is receiving the money from the government. So the money flow here is from the buyer to the seller. So in this case, public will have more amount of money if government buys the bond from the public. So more number of money or more amount of money will be available in the hands of the public. So as a result, we can see that the money supply in the economy will increase. The fifth problem or fifth question is to analyze the impact of increase in credit limit. This is again a qualitative measurement or qualitative monetary tool that the central bank uses to control the money supply. So let us first understand what is credit limit. So credit limit is basically the maximum limit or maximum amount of loan and advances that can be given in the form of credit. Now, RBI fixes a credit amount to be granted to the commercial banks. When credit is given by limiting the amount available for each commercial bank is compulsory. Now, the thing is that if the commercial bank doesn't have any credit limit, in that case, commercial banks can give any amount of money in the form of credit to the borrower or who is asking for that money to the commercial banks, because ultimately commercial banks can make the money by giving the money to the public in the form of loan. But if the loan amount cannot be recovered by the commercial banks, then who will be the sufferer? Sufferer will be the depositors or the people who have kept their money with the commercial banks. So, in that case, RBI has to make a balance between both the depositors as well as the people who have borrowed the money from the commercial banks. Will be the impact of the credit limit. Credit limit, if government increases, credit limit increase means more amount of loan can be given to the borrower, or uh, extending the maximum amount of loan. So more amount of loan or more amount of money is coming to the borrower. So more money, more money. Why? Because of extending the limit. Because of because of extending the limit. Increasing means extending. In this case, increasing the credit limit means extending the credit limit. It will lead to increase in the money supply in the hands of the public. So here in this video, we have considered 5 cases, and we have seen that if the bank rate or repo rate, if they are increased, then it has a negative impact on the money supply. And the same kind of uh, mm, mm, outcome we can see when the margin requirement has increased. On contrary, we have seen if government buys the bonds from the public, or if government increases the credit limit, the money supply in the hands of the public will increase. I hope it is clear from this video that how various monetary policies or monetary policy tools are used to regulate or control the money supply of an economy. If you have any question, you can ask me in the comment section. Thank you.